One thing we have to keep in mind is when markets fall this quickly from a 52-week high, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And I do think two other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
The stock market just pulled off an impressive bounce back, but don't be fooled. The past few weeks have been a roller coaster for investors. On Saturday, U.S. stocks surged, clawing back some of the brutal losses from the previous session. The S&P 500 closed up 2.1%. The Nasdaq Composite soared 2.6%, and the Dow gained 1.7%. But let's put things in perspective. This wasn't just a random green day. It came after a relentless 4-week losing streak, the longest since August last year. Despite Friday's rally, the weekly performance remained deep. In there, the S&P fell 2.3%, the Nasdaq 2.4%, and the Dow tumbled 3%. The market's turmoil is largely driven by escalating tariff tensions and fears of an economic slowdown. Investors have been scrambling, worried that rising trade barriers could derail global growth. The result, a sharp sell-off that dragged markets down from their 52-week highs. Just weeks ago, we were hitting all-time records. And now the fear of a prolonged downturn has set in, but note everyone is panicking. Fundstrat's Tom Lee sees this differently. He believes that markets have already priced in a crisis with recession fears overblown. Drawing a fascinating parallel, he compares this sell-off to past crises like the Cube crisis of 1962, where markets bottomed out 7 days into the crisis and rebounded before it was even over. Lee remains firmly bullish, expecting a tariff resolution soon, and predicting that this panic-driven correction is temporary. And here's the kicker. Friday's rally wasn't just a dead cat bounce. It was fueled by stocks that got unfairly punished in the recent sell-off. These same stocks will now lead the next room, making this the perfect buy-the opportunity before the market resumes its climb. And remember, Tom Lee has a price target of 7,000 for the S&P 500 this year. That's a massive upside from here. If history is any guide, we're on the verge of a major recovery, and the next big green week might just be around the corner. Let's begin with the first stock on our list, NVIDIA Corporation, ticker symbol NVDA. After more than 2 weeks of sliding, NVIDIA roared back over 5% on Friday, helping lift the entire market. And for good reason. This isn't just any stock. This is the backbone of AI data centers and next-gen computing. With NVIDIA's fundamentals and long-term trajectory still intact, this could be one of the biggest gainers in the upcoming market recovery. NVIDIA is at the heart of the AI revolution. Its H100 and Blackwell GPUs power everything from OpenAI's ChatGPT to Tesla's autonomous driving fleet. Despite increasing competition from AMD and DeepSeek, NVIDIA continues to dominate the AI and data center market. The compute and networking segment, which includes AI cloud computing and autonomous vehicle tech, saw massive revenue growth, up 78% year-over-year. That's unheard of for a company of this size. Now let's talk about the opportunity. NVIDIA has pulled back from its all-time highs, presenting an incredible chance to buy the dip. Historically, whenever NVIDIA corrects 20 to 30% from its highs, it has roared back even stronger. And we're not just talking about a small bounce. Tom Lee has a 7,000 target on the S&P 500 this year, and NVIDIA will be a major driver of that rally. Here's the bottom line. The AI arms race is only just beginning. Demand for NVIDIA's GPUs isn't slowing down, it's accelerating. Companies like Microsoft, Meta, and Google are spending billions on AI infrastructure. And guess who's providing the chips? NVIDIA. This is a company with insane pricing power, deep technology moat, and a track record of defying the bears. With the market recovering, this is the perfect time to load up on NVIDIA before the next leg higher. Next up, Supermicro Computer Inc. ticker symbol SMCI, a stock that just staged a powerful comeback, surging over 7% on Friday. After enduring a week sell-off, SMCI's rally signals a shift in momentum, aligning with the broader market recovery. And let's be clear, this isn't just a short-term bounce. The underlying business fundamentals remain rock solid. Supermicro is riding one of the biggest technological transformations in history, the AI-driven data center revolution. This company specializes in high-performance computing infrastructure, providing AI-optimized servers and liquid-cooled racks that power next-gen data centers. With NVIDIA's transition from Hopper to Blackwell GPUs, SMCI is now ramping up mass production of its next-gen AI server systems, which will be critical in meeting the explosive demand from hyperscalers like Microsoft, Amazon, Google, and Meta. Despite analyst skepticism, SMCI's own management remains incredibly bullish, forecasting $40 billion in revenue for fiscal year 2026, a staggering 65% year-over-year growth. Compare that to Wall Street's conservative estimate of $33 billion, and you see a massive potential upside if the company delivers. And given Oracle's recent $130 billion cloud backlog, there's clear evidence that AI computing demand is still booming. Adding to the bullish case, SMCI is expanding production capacity aggressively with new facilities in the US, Taiwan, and Malaysia, ensuring it can meet the flood of demand expected in 2026. Inventory levels have been strategically reduced, suggesting the company is preparing for a major pop in shipments once GPU supply bottlenecks cease. With Friday's strong rebound and a clear path toward exponential growth, Supermicro is perfectly positioned to ride the AI-driven data center boom as the market recovery unfolds. This is exactly the kind of stock that could lead the next leg higher, making this a prime buy the dip opportunity. And last but certainly not least, Micron Technology Inc. ticker symbol MUA stock that just surged over 6% on Friday, signaling a strong reversal after weeks of relentless selling. Micron has been through a rough stretch, shedding nearly 40% from its June 2024 peak, largely due to concerns that the memory cycle had already peaked. But here's the thing: Wall Street is wrong. This isn't the end of the cycle, it's just getting started. While traditional DRAM and NAND markets have seen a slowdown, the real game cherish high bandwidth memory, the critical component powering AI cloud computing and high-performance data centers. Micron has locked in $3.88 billion in HBM revenue for this fiscal year, and that number is expected to nearly double to $675 billion in 2026. This is a hockey stick growth trajectory unlike anything seen in past memory cycles. Demand is so intense that Micron's entire capacity for 2025 is already booked. That means every chip it produces is already spoken for. There's no surplus oversupply, just pure revenue acceleration. Meanwhile, the traditional memory market is stabilizing, and early signs indicate that NAND pricing will improve by mid-year. And here's where it gets even better: Micron's profitability is set to explode with HBM. Commanding higher margins, the company is expected to push its net profit margin up to 20%, far above historical averages. That means higher earnings, a stronger balance sheet, and a major re-rating for the stock. At current levels, Micron is trading at a steep discount, and analysts are missing the full scope of its HBM potential. Based on revenue projections, the stock should be worth $44 more than today's price, hitting $122 per share. As the market recovers, Micron is positioned for a massive breakout. The combination of AI-driven HBM demand, NAND, D-price stabilization, and an underestimated memory cycle means that now is the perfect time to load up on MU before Wall Street catches on.